Most traders open a chart and immediately zoom in. One candle, one move, one setup. But the market was already telling a story long before that entry appeared. And if you ignore the higher time frames, you trade blind, because the real edge isn't predicting the next candle. It's understanding where price is located inside the bigger picture. Most traders never realize the chart is layered, and that changes everything. Retail traders are trained to chase entries, 5-minute setups, 1-minute reversals, tiny candle patterns. But the market doesn't move randomly between time frames. The lower time frame obeys the higher time frame. A 5-minute breakout inside a daily downtrend is often just noise. This is where accounts disappear, because traders confuse movement with direction. Top-down analysis is simple. Start high, move lower, monthly, weekly, daily, 4-hour. Then execution time frame. You begin with context before searching for entries. The higher time frame tells you where price is likely moving, where liquidity exists, where major reactions happen. Then, the lower time frame helps refine execution. Professionals don't start with entries. They start with location. Most traders become emotionally attached to the lower time frame. Every candle feels urgent. Every pullback feels dangerous. Every breakout feels real. But zooming in too early creates emotional distortion. Fear increases. Patience disappears. And traders begin reacting instead of analyzing. The market doesn't care about your emotions, but higher time frame structure can calm them. New traders expect precision, perfect entries, perfect tops, perfect bottoms. But professionals think differently. They think in zones, probabilities, context. A higher time frame demand zone does not guarantee reversal. It creates opportunity. And that small shift in thinking changes how you trade forever. The framework is simple. Higher time frame determines bias, structure, key levels. Then lower time frame determines timing, entries, risk management. The market is not one chart. It is multiple layers working together. And once you understand that, random price action begins making sense. Two traders see the same setup. One trader buys immediately because the 5-minute chart looks bullish. The other checks the daily chart first. He notices price approaching major resistance. One trader sees opportunity. The other sees danger. Same chart, different perspective. And perspective is everything in trading. Professional traders are patient, not because they are smarter, but because they understand positioning. They wait for price to align across multiple time frames. That alignment creates confidence, not certainty. Confidence, because the best traders in the world still lose trades, but they lose inside a structured framework, and that changes the psychology completely. Step 1. Start with a weekly chart. Mark major support and resistance. Step 2. Move to the daily time frame. Identify structure and trend direction. Step 3. Drop to execution time frame. Wait for confirmation. Then enter with context, not emotion. Simple, but powerful, because top-down analysis forces discipline. And discipline is what most traders are actually missing. Most traders search for the perfect strategy, but the real difference is perspective. Top-down analysis teaches you to slow down, to think clearly, to understand context before emotion takes over, because the market is not random chaos. It is structured movement. And once you learn to read that structure, everything changes. The entries become cleaner, the emotions become quieter, and the chart finally starts making sense.